Hello, my name is Bill Bakamora, and I'll be talking about how you can use ratio analysis to sort of analyze any organization. And in this example, I'll be using ratio analysis to analyze a company called Carnival PLC, which is part of the UK FTSE 100. The aim of this presentation is to analyze different financial ratios that can be used by different stakeholders to analyze the financial performance of an organization. The report is calculating different financial ratios such as profitability ratios, liquidity ratios, gearing ratios, efficiency ratios, and investor ratios of Carnival PLC. Ratio analysis is a process of comparing a relationship between two different financial accounts, such as balance sheet and income statement. Different stakeholders use ratio analysis for different purposes, and the objective of ratio analysis is to measure performance and to evaluate the operational efficiency of an organization to take an appropriate decision. First, we'll talk about profitability ratio. This ratio are used to evaluate an income statement account to determine the capability of an organization to generate profits from the operational activities. The values of these ratios are presenting variations in both financial years. Gross profit margin ratio is determining the comparison of gross profit to net sales. Gross profit margin ratio is used to measure how an organization is selling its inventory in a profitable manner. Gross profit margin ratio of Carnival PLC was 43% in 2016, and this was reduced to 40% in 2017. From the income statement of this company, it is analyzed that total sales of the company decreased in 2017 as compared to 2016, but the increased cost of goods and services has influenced the gross profit margin. Due to increased cost, the profitability of Carnival PLC has been decreased in 2017. In addition, the income tax also increased from with the sales revenue. Due to this cause, the net profit margin of the company also decreased in 2017 from 16.95% to 14.88%. In addition, return on assets, that's the ROA of the company, was 7.14% in 2016, which was decreased to 6.30% in 2017. ROA determines how an organization is utilizing its assets in producing profit. The decreasing value of ROA is determining that the company is not able to use its assets in gaining profit from operational activities. It is also analyzed that return on equity, that's ROE of Carnival PLC, decreased in financial year 2017 to 2016. The ROE was 12.29% in 2016 and 10.76% in 2017. The financial statements of the company are presenting that the total equity has been increased in 2017, but the net income not increased in the same manner. In this concern, it is analyzed that the ability of generating profit from stakeholders' investment has been decreased in financial year 2017. Next is liquidity ratio. The liquidity ratios are used by individuals to evaluate the ability of an organization to pay off the current obligations and current liabilities through use of its current assets. The liquidity ratios. So as you can see from here, the first of the ratios is current ratio, and second is a quick ratio. The current ratio was 24% in 2016 and 18% in 2017. So there's been a significant decrease. And the quick ratio also decreased from 19 was 19% in 2016. This decreased to 14% in 2017. The liquidity ratios are presenting that the ability of the company to use current assets to pay off current liabilities has been decreased in 2017 as compared to 2016. Now, if we talk about gearing ratios, now this is used to evaluate the proportion of debt fund of an organization to its equity. And in 2016, the debt to equity, the gearing ratio, debt to equity ratio was 42.59%, and then this decreased to 37.97%. The decreasing debt to equity ratio is presenting lower financial risk for the company. So it's actually a good thing, which is favorable for the company for further expansion. And then next is efficiency ratios. These ratios are helpful in measuring the ability of an organization to use the assets in generating income. So we have account receivables, turnover, which was 54.99 in 2016 to this 56.12 2017. Next is working capital ratio, which was 24% in 2016, and this decreased to 18% in 2017. Then you have asset turnover and inventory turnover. So you can see the asset turnover here, 42.15% to 42.94, marginal increase. Then you have inventory turnover, 29.13 to 27.13. From the above table, it is analyzed that percentage of assets as compared to liabilities has been decreased in 2017, which is not good for the company for further achievement, as increased liabilities can increase financial risk to the company. Then we have investor ratios. These ratios help investors in analyzing the financial position of and ability of an organization to sustain in the industry. So we have return on investments, return on tangible equity, and price earning ratio, presented here by PE ratio. So you have ROI, that's from 8.99 2016 to 8.35 in 2017, so that is a decrease. You have return on tangible equity, 15.09% to 12.99%, that's another decrease. Price earning ratio has actually gone up from 13.12 to 18.12. The increase in price earning ratio is determining that the company will get good growth in the future and provide good returns to the investors on their investment. Okay. Now there are a bit of limitations on of ratio analysis, and then the first is incorrect or false accounting information. As a ratio analysis is based on information obtained from the financial statements, therefore false or incorrect information may be a cause of inappropriate analysis, and you have no idea about what's happening in the future. The ratios are attempted on basis of past financial statements or historical data. In this concern, only a probability may be discussed through ratio analysis. The ratios are not able to provide a strong assumption for future happenings. Then you have different accounting policies. Different accounting policies are used for valuation of and depreciation and inventories to make accounting ratios and accounting in different organizations. In this concern, there may be variations in results of similar ratios for different organizations. Okay, and lastly, you have unavailability of common standards. They are not fixed standards to evaluate the ideal ratios. The standards are different from the nature of each industry. A few recommendations for Carnival PLC. First is to develop an effective financial strategy to manage the financial activities in a proper manner. Secondly, to develop a strong internal control and to utilize maximum of assets in operational activities. And then third is to manage inventory systems in a proper manner and make efforts to decrease the inventory in a quick manner. And then finally is to make efforts to reduce costs and expenses on different operational activities. It is my hope that this podcast may have probably picked up a few things to help you in analyzing the company. In conclusion, ratio analysis played an essential role in analyzing the potential and performance of an organization. Ratio analysis can be used by management in taking an effective decision. This is the end of this podcast.